Oh boy, are you guys ready for this? I don't think you guys are ready for this. We're going to talk about three very important things here in this video. Hopefully you guys see it by tomorrow morning. If you don't, no worries. This information will be relevant for a long time to come. First things first, how Morgan Stanley's longtime equities bear says U.S. stocks are ripe for a short-term rally. We reported on this earlier, but now we have the actual video of what was said, what he actually said alone. His explanation of why the markets are likely to rally was so important that it helped cause some of this rally today, and you are seeing a lot more other Wall Street bears over the last 6 to 12 months starting to agree with him. And we have the actual video. It's about 3.5-4 minutes long. Highly recommend you guys watch that because nobody else could say it better than he does. So something you guys definitely want to watch. The second thing is going to be the fact that the SEC paid nearly $100,000 to produce a 30-second video that warned investors against betting on meme stocks such as GameStop and AMC. I think if that doesn't speak volume to you, then you probably just got into the markets, because what's that really telling you? Well, we're going to talk about that here in this video. And the third thing is the positioning of hedge funds today and over the past couple of days. More specifically, what their actual trades are, because some of these trades are massive. A $24.5 million option trade on the S&P 500 expiring October 21st by this Friday. Another $9 million trade, another $18 million trade, $15 million trade. Some of these are pretty far out the money. So you're starting to get a lot of very bullish positioning, and we're going to talk about exactly where they are betting the markets will go, guys. So let's get straight into this information. First and foremost, that's what I want to start with. The fact that the SEC reportedly paid nearly $100,000 to produce this video. And I think this is really funny. Most importantly, it's something you have to shed light on, because why would they do this if they didn't have an incentive to do this? Is this really where, taxpayer dollars are best spent? Telling people what they should and shouldn't do. And this is the video, just in case you guys haven't seen it, if you were not invested in the whole meme stock rally over the last 6 to 12 months. It's this goofy video that we all remember talking about. Just absolutely wild there. They actually paid $100,000 to make that. Who are they trying to protect there, right? Who are they trying to protect? They're trying to protect Wall Street, the hedge funds here. Because why? Because retail is powerful, and more specifically, retail around specific companies. Like, think back to 2020, 2021, 2022, some of the big runners throughout the last couple of years. They're not all powerful, right? They don't all have the potential to come back and go through a monstrous rally. A lot of them never will. But the ones with a community, the ones with a backing behind them, those are the ones that could really disrupt Wall Street and could really see retail well outperforming the hedge funds, just like we did over the last couple of years. Anyways, 2020, 2021, those were both stellar years for the individual investor, and retail investors, individual investors have been doing pretty good throughout 2022 as well. We have actually been the main buyer in the markets when nobody else wanted to buy stocks. Retail held it down, and we're going to be the ones to come out on top when all of this is said and done, hopefully with a couple massive short squeezes at the same time, and hopefully those options can print some sweet tendies, baby. But in the meantime, it is very important to stay up to date with especially people like Morgan Stanley's chief global strategist opinions and statements that they make, and hedge fund positioning in the markets, so you can be actually prepared to take advantage of that, so you can make option trades when these stocks do short squeeze, so you have the knowledge to actually make money. That's what these videos are for, and that's why we're going to play this video basically the explanation of why the stock market is about to go through a massive short squeeze in Morgan Stanley's Wilson's words. Yes, that was a mouthful. Let's get into it. We'll be back after this short video.
Your call may be responsible for at least part of this rally, but looking deeper into your piece from this morning, I am stopped when you say, to be crystal clear, we think a tradable bear market rally began last Thursday. However, we also believe the 200-week moving average will eventually give way, like it typically does when earnings forecasts fall by more than 20%. So you're still not long-term bullish.
Well, by the way, thanks for having me. We're long-term bullish, but long-term is in the eye of the beholder. In fact, one thing maybe I'll start out by saying is we've been obviously more bearish than most this whole year, but I would say we're starting to get to a point where, our intermediate term view is probably more constructive. Let me just spend a minute on that. That'll explain some of the reason for this tactical call. But first of all, we do not think this is the 1970s. We do not think this is a cost push inflation. It's a demand pull inflation. It's very serious. We actually called for that back in 2020. It played out in a positive way initially with earnings, being the beneficiary of that, stocks also benefiting from that. But now we're in a bust, and that bust is not fully played out. So, yes, we think the earnings recession and probably an economic recession at some point will play through, and that's not fully priced. However, the room has gotten crowded, and we don't tend to trade against our core view too frequently, but we felt like this is a good chance to do that. We've had a bearish view for all year. We think the 200-week moving average is a really important technical level that a lot of people don't talk about. We felt like that would be touched maybe in June. We didn't get there, which is one of the reasons we didn't turn bullish for that rally, which turned out to be very powerful. But this one is the same idea. The bear market is not over, but you can have major moves off of these technical support levels, and that's the world we've been in. It's technicals versus the fundamentals, and so we got to play it both ways. We can't get too dogmatic in our views. We've been bearish all year, and it's time for some relief.
Understood. But again, to make it clear, though, your view of overall earnings and the resultant discount, or I should say reduction perhaps in the multiple or simply in the market as a result of that, remains, correct?
That's correct. So we haven't seen the things that we need to see to call the end to this bear market, which is fundamentally driven, right? We overheated. The Fed reacted to that. Financial conditions are tightening, and now we're going to feel the effects of that on growth mostly next year. And the good news is the market is discounted, I would say, almost 100% of what the Fed's done at this point. And I would say they've discounted very little of the earnings impact that's going to be felt next year. But in the middle of that transition, you can have these periods where stocks can dream about, hey, maybe we aren't going to get that growth effect, and rates start coming down for technical reasons and fundamental reasons, right? 4% 10-year is pricing a lot of what the Fed is still to do. And the UK situation, which I think was probably responsible for the last 50 basis points of this move, is now maybe turning the other direction. So you have rate support potentially that could get into stock prices in the short term before it becomes crystal clear that our call for earnings is really playing out. That may take until the January, February reporting season.
Your point about fundamental reasons for rates to come down is interesting. On Friday, I think it was Ellen Zentner put out a chart of your view, the house view of core PCE really returning to the twos by the middle of next year on a 6-month annualized basis. I wonder what you think that environment's going to feel like. Will we have Fed funds above inflation? And how do you keep the bulls from really rocketing even higher than your call says?
Well, that's right, Carl. So I think the market will feel pretty good about that when it's happening. Now, let's make no mistake about it, okay? Last week's inflationary numbers are still way too high. And so that decline that Ellen's looking for, okay, is not going to happen in the next 3 months. However, markets are forward thinking, just like they are in the equity market. And so we think that could start to get into the rates market. We're not calling for rates to fall down, but maybe they just stop going up. That can be enough for, once again, equity markets to get excited. Unfortunately, I don't think we can avoid, this earnings recession that is coming next year, because at this point, the Fed's already done enough to create that, in addition to the natural ebbing and flowing of the earnings cycle on its own.
Welcome back, guys. Like I said, there needs no other explanation on why this rally is likely. You heard it from one of the top guys in the industry, and like I said in the beginning of this video, he said it better than anyone else is going to. So we're going to leave it on that note, but we're going to look now at the hedge fund positioning for this actual rally, because a lot of the time hedge funds, these algos, when they put in these trades worth $25 million, they're not in it to YOLO money, they're in it to actually make money. Obviously, right? They're not going to throw away $25 million, right? For an example, or even potentially more than that. They're going to make a logical trade based off of trading algorithms, off of technicals, off of other factors. When you see trades like that, they usually don't lose on those trades, especially when you're at the beginning of a bear market rally. Right now, can you even say a bear market rally has actually begun? Yes, Morgan Stanley, they think it started Thursday, but we are hardly higher than where we were Thursday, right? I don't even think we actually are higher than the intraday high on Thursday right now. So you could say, they could say whatever they want, but you're still at the beginning of it. So the money is to be made now. It's to position now for a potential bear market rally. So you get in now, you take profits towards the top. That's the way to do it. So that's a big reason why looking at these individual trades can be so profitable. And we're not looking at small trades here. We're looking at $3 million plus, and I can actually tune that up. Let's put it to $5 million and see what we get. Might take a second to load to filter through, but you do see an October 21st $345 call, and I should say this is on the S&P 500, the most closely watched index in the world, with a break even of around 367.29, which we are above that right now, and that's one of those trades where they're betting that we have a lot more upside from here. If we fall, if we have a bad day tomorrow, the trade's going to be losing millions of dollars, right? So it's one of those, they're still betting that the markets are going to go a lot higher. And now this one is definitely a lot more bullish. December 16th, $400 call worth $18.36 million. They spent $459 on this, a break even of about 405 on the S&P 500. That's an $18 million trade for a relatively short amount of time by December 16th, especially when you have midterm elections coming up. They are expecting a very big rally to be coming over the next couple of days, next couple of weeks. Also, this trade does expire by Friday, October 21st, a 360 call for $15 million. Spent $5, so a break even about 365. So they did break even on that trade today. But again, you're not in some of these trades to make $100,000. You're trying to make millions of dollars, right? You're trying to at least make 20%. If you put in $5 million on that trade, $1 million would be a 20% profit, right? That's pretty standard for the hedge fund industry. Now, looking at some of these other trades, you can see this hedge fund did sell $400 puts for December 16th. That was a $6 million trade. That is ultra bullish on the markets from my perspective on where I see it as of right now. And you do have a lot of people that are actually selling puts here today. Probably something that looks to be pretty profitable, especially if we do continue to make our way to the upside. And you are seeing some hedging, but by and large, these trades are very directionally bullish that we have been seeing over the last couple of days, because even if you look at what we've seen today, you had $638.57 million worth of options that were placed on the S&P 500 with a positive order value of 79% and about 5,400 options total that were placed on the S&P 500. And if you even look, to something even more bullish, you could see a December 16th 390 call worth $10.34 million. That is also, like I said, extremely bullish. That's not even close to going into the money right now. To throw around $10 million at that, you got to have some pretty high conviction levels of a pretty big bear market rally that is to come. So, guys, that's pretty much going to be it. Here you have a November 18th $400 call worth $7.15 million. Again, very, very bullish direction, pretty far out the money. Come here. You want to say hi? You want to say hi? Say hi. Say to the moon. Say to the moon. To the moon. To the moon. To the moon.
Daddy.
What? Say to the moon.
But
Say I love you.
you.
Okay. That's fair enough. She still won't do to the moon, but got the love you in there. So that's gonna pretty much do it for this video. You guys get the gist by now. A lot of bullish positioning. A lot of these orders are, you know, tens of millions of dollars positioning around the 390, around the $400 strikes for November, for December. That's less than 2 months away, guys, even for the December contract. So woo, that's going to be all for this video. Thank you guys for watching. Hit that like button, subscribe to the channel. If you guys have not gotten free stock with Weeble Moo and Public, links down below in the description. And if you guys want to come trade with me live in real time, link down below in the description as well. Thank you guys for watching. Sorry about your ears on that one. I'll see you in the next one.